An estimated 6 satellites per day. That is the manufacturing rate most analysts never quote when they cover SpaceX. They focus on the rocket. The rocket is not the moat. A Falcon 9 lifted off from SLC-40 in Florida today, March 27, 2026, carrying another Starlink batch. That is one data point. The pattern behind it is the real signal. The U.S. Space Force just handed SpaceX 9 task orders worth $739 million for national security launches. That is the difference between buying a launch company and buying the world's first high-volume satellite production infrastructure. Those are not the same bet. 2 confirmed events are driving today's analysis. First, a Falcon 9 launched from Space Launch Complex 40, Florida, on March 27, 2026, carrying Starlink satellites. SpaceX's operational cadence is not slowing. This is a routine production event, not a milestone. Second, the U.S. Space Force awarded SpaceX 9 task orders totaling $739 million under the National Security Space Launch Phase 3, Lane 1 program. 9 orders at $739 million implies an average contract value of approximately $82.1 million per mission, our estimate, assuming equal distribution across all 9 orders. The U.S. government is paying a premium for assured access. And it is likely still below what competing launch providers charge. The contracting agency is the U.S. Space Force. SpaceX is now formally embedded in the national security launch architecture, not just the commercial one. That dual market position creates revenue durability a purely commercial launch provider cannot replicate. Here is the next question. Is the engineering stack behind that position as solid as the contract sheet suggests? Falcon 9 sits at Trail 9. It is in routine operational service with a long, publicly documented flight history. Further maturation of the core system is irrelevant to near-term risk. The failure mode picture, however, is more nuanced than the headline success rate implies. Failure mode 1, second stage engine anomaly during orbital insertion. Severity 9. Occurrence 2. Detectability 3. An RPN of 54. The Merlin vacuum engine undergoes extensive pre-flight acceptance testing, and redundant ignition systems are standard. A failure here is rare, but catastrophic. Total payload loss, plus potential orbital debris creation. Failure mode 2, post-separation satellite deployment system fault. Severity 8. Occurrence 3. Detectability 5. An RPN of 120. This is the highest risk failure mode in the stack. Deployment is telemetered, but a mechanical jam or software fault may only be confirmed after the sequence completes. A batch of satellites, representing months of manufacturing throughput, can be lost at the last mechanical interface. Failure mode 3, first stage landing failure following successful launch. Severity 4. Occurrence 5. Detectability 1. An RPN of 20. Landing is heavily instrumented in real time. The primary mission survives, but a reusable asset worth tens of millions is destroyed. The deployment fault is 6 times riskier than a landing failure. Most coverage ignores it entirely. There is a fourth risk no FMEA table captures cleanly: process failure under tempo pressure. Documentation errors, configuration control lapses, and range coordination gaps all become more probable as cadence increases. That failure mode has no published RPN. But it should. Failure mode 4, quality escape due to accelerated production tempo. Severity 7. Occurrence 4. Detectability 6. An RPN of 168. This risk targets the satellite production line itself, the claimed core moat. As the estimated build rate pushes toward 6 units per day, the validation cycle for components like solar arrays, reaction wheels, and inter-satellite laser links compresses. A latent defect in a high-volume part could escape pre-ship review and propagate into dozens of satellites before telemetry from orbit confirms the flaw. The financial impact is not a single launch loss, but a cohort of degraded assets and a forced slowdown of the constellation build-out to diagnose and rectify the systemic issue. The supply chain story has named winners and named losers. The mechanism is volume. AMD is cited by analysts as a direct beneficiary. Reports indicate SpaceX's Starlink satellites and ground terminals use custom AMD Zen-based CPUs, as referenced in AMD's earnings commentary. Every satellite added to the constellation is a volume production order for AMD silicon. That design win scales with launch cadence, not with a single contract. L3Harris, LHX, and Microchip Technology, MCHP, supply radiation-tolerant electronics and processing components for the broader proliferated LEO architecture. The shift from bespoke rad-hard procurement to higher-volume COTS-enhanced parts directly expands their addressable market. Losers, Boeing, BA, and Lockheed Martin, LMT, as co-owners of United Launch Alliance, face direct erosion. The NSSL Phase 3 Lane 1 award of 9 task orders to SpaceX is not a one-off. It is a structural shift in government launch procurement. ULA's Vulcan Centaur has been reported by industry publications to cost an estimated $100 to $150 million per mission, a figure that has not been officially confirmed by ULA. SpaceX's implied average government contract rate is approximately $82.1 million per mission, our estimate, assuming equal distribution across the 9 orders. That gap compounds over a 36-month horizon as NSSL Phase 3 Lane 2 awards approach. Here is what that actually means. The Lane 2 award decision is expected within 12 months. Lane 2 covers more complex, higher-mass national security payloads, the last domain where ULA holds a credible technical argument. The next 12 months will determine whether ULA retains any meaningful share of the government launch market. The bull case is straightforward. SpaceX holds a dual market position, commercial Starlink subscriptions plus government NSSL contracts, that no competitor currently replicates at scale. The $739 million NSSL award provides contractually assured revenue. If Starlink reaches full operational capacity within 36 months, the network effect, coverage density, latency, and terminal volume, creates a switching cost moat that pure launch economics cannot capture. Conservative scenario, 2026 to 2027. Launch cadence holds at roughly 1 mission every 2 weeks. Satellite build rate stays near 550 satellites per year, our estimate, assuming approximately 21 satellites per launch at current tempo. NSSL revenue contribution remains at the contracted $82.1 million average per mission, our estimate. Starlink profitability data remains undisclosed. No margin expansion confirmed. Base scenario, 2027 to 2028. Cadence increases toward 1 launch per week. Build rate approaches 1,150 satellites per year, our estimate, assuming approximately 22 satellites per launch at peak capacity. The Lane 2 NSSL award adds incremental government revenue. AMD and LHX supply chain volumes scale proportionally. Optimistic scenario, 2028 to 2029. Starship reaches TRL-9, estimated 2 to 5 year timeline from today. Per kilogram launch cost collapses. Starlink manufacturing scale, already at an estimated 6 satellites per day, creates a constellation replenishment rate competitors cannot match. That spread, 2026 to 2029, is the entire investment thesis. Here is the merged insight most coverage misses. The engineering picture shows the highest risk failure mode is not the rocket engine. It is the satellite deployment interface, RPN 120. The financial picture shows the highest value mode is not cheap launches. It is high-volume satellite manufacturing. Both point to the same conclusion: the constellation production line is both the primary asset and the primary vulnerability. Investors pricing SpaceX's supply chain as a launch story are modeling the wrong variable. Watch the NSSL Phase 3 Lane 2 award. That single procurement decision will reveal whether the U.S. government views SpaceX as a preferred provider or a sole source dependency. Those carry very different risk profiles for the entire sector. The companies named today, AMD, LHX, BA, LMT, will move on that signal before most analysts update their models. This video is for informational and educational purposes only and does not constitute financial advice. If this analysis gave you a framework you can actually use, subscribe. New signals drop every week.